You're not going to believe what just came out. RAM, one of the most influential and data-backed financial analytics firms, has sounded the alarm, and this time, it's not just a blip on the radar. This is a full-scale warning shot aimed directly at the U.S. economy. According to their latest report, we're heading into a storm that could redefine everything from job security to market stability, and the signs are showing up faster than most people realize. Inflation may have cooled on paper, but RIMS analysts say it's a mirage. Core spending patterns are eroding. Consumer confidence is sinking, and corporate debt loads are ticking time bombs just waiting for a spark. Even more alarming, they're flagging something that mainstream media has barely touched: a sharp drop in manufacturing momentum across sectors that traditionally lead recoveries. If RIMS projections hold, we're not talking about a soft landing or even a mild slowdown. We're staring straight down the barrel of what could be a prolonged economic freeze. They point to credit card delinquency surging to levels we haven't seen since 2008, and mortgage defaults inching higher quarter after quarter. But here's the kicker: they believe the Fed is already cornered. Raising rates could choke off what little growth is left, but lowering them too soon might ignite inflation all over again. It's a classic no-win scenario, and RAM says the clock is ticking faster than policymakers are willing to admit. What's even more jaw-dropping is their breakdown of the labor market, which RAM claims is far weaker than the headline numbers suggest. Behind every new job touted in the reports is a wave of part-time, low-wage work replacing full-time positions that offered stability and benefits. Add to that the sharp drop in small business lending, and it becomes clear this isn't a temporary dip. It's a foundational shift, and here's where it gets really intense.
RIMS warning doesn't just stop at data points. It drills into the psychology of the market, the emotional undercurrents that fuel spending, investment, and risk-taking. And right now, that psychology is breaking down. Consumer sentiment is in free fall, and it's not just because of high prices. It's because people no longer trust the system to rebound like it used to. RAM's analysts are pointing to a dangerous shift, where Americans are pulling back on discretionary spending faster than expected. We're seeing early indicators in retail, hospitality, and even tech sectors that were once bulletproof are now bleeding revenue and slashing forecasts. They even highlighted the chilling stat: over 65% of middle-income households have either stopped saving entirely or are dipping into savings just to cover monthly expenses. That's not a slowdown, that's survival mode. And that gap, it's becoming a flashpoint. RAM notes a sharp increase in economic polarization, with the top 10% growing their net worth through strategic plays, while the bottom 60% fall further behind. That kind of imbalance doesn't just strain households, it stresses the entire social fabric. RAM believes this rising inequality will drive political unrest, push populist policies to the forefront, and potentially trigger market-disrupting legislation. Think aggressive corporate taxation, wealth caps, or forced regulatory restructuring of the financial sector. These are not distant hypotheticals anymore. They're fast becoming real probabilities according to RIMS trajectory modeling. And if those kinds of shocks hit while the system is already vulnerable, then we're looking at a fundamental reshaping of America's role in the global economy. RAM's latest capital flow data shows something truly alarming. International investors are starting to rotate out of U.S. assets at a faster pace than any time in the last decade. We're not just talking about a few hedge funds repositioning. Sovereign wealth funds, global pensions, and institutional giants are quietly redirecting billions into non-U.S. markets, favoring commodities, emerging economies, and even rival currencies. RAM calls it a silent vote of no confidence. And when international capital starts pulling back from U.S. bonds, stocks, and real estate, the ripple effects are enormous: less liquidity, weaker asset prices, higher interest rates, and a much more fragile financial system. They have also issued a sharp warning about the dollar's shrinking dominance. While it's still the world's reserve currency, RAM highlights that central banks around the globe have been diversifying away from dollar-denominated reserves at an accelerating pace. That's not theoretical, it's happening now. China, Russia, Brazil, even some EU countries are gradually building trade and reserve structures that reduce dollar dependency. And if that trend continues, the U.S. will lose one of its most powerful advantages: the ability to borrow and spend on the global stage with virtually no consequence. RAM believes that moment once unthinkable is now within reach within the next 5 to 7 years unless structural corrections are made. But the most disturbing part of RIMS analysis It's not just the big institutions repositioning. It's the average American starting to feel the impact in real time. RAM's Consumer Trend Index shows people are downsizing everything: cars, homes, even grocery bills, not because they want to save, but because they have to. Middle-income families are trading organic food for store brands, postponing medical treatments, cutting back on insurance coverage. That's not budgeting, that's economic distress. RAM notes a sharp uptick in emergency withdrawals from retirement accounts, another signal that people are being forced to eat into their future just to survive the present. And this distress is beginning to change behaviors deeply. Americans are working longer hours, delaying retirement, and taking second jobs, not to build wealth, but to keep the lights on. RAM warns the shift will have lasting consequences on productivity, mental health, and even social cohesion. They see the early signs of what they call economic fatigue, a phenomenon where people disengage not just from spending, but from participation in the economy entirely. They stop starting businesses, stop investing, stop believing that things can improve. And when that belief fades across millions of people, recovery becomes 10 times harder, no matter what policies are introduced. Those early consequences are already showing up in ways that are subtle but significant. One of the most jarring data points RAM highlights is the sharp drop in new business formations. Historically, during times of crisis, entrepreneurship in America has surged as people look to innovate their way out of hardship. But this time, it's different. The rate of small business creation has slowed to a crawl, and RAM believes it's due to a toxic combination of limited access to capital, declining consumer demand, and overwhelming regulatory uncertainty. Entrepreneurs aren't betting on the future, they're retreating from it. That's a dangerous signal, because it suggests that even America's risk takers are losing confidence in the system's ability to support them. Meanwhile, corporate behavior is shifting too. RAM's internal data shows Fortune 500 companies hoarding cash like it's 2009 again, instead of reinvesting in innovation or expansion. Many are stacking reserves, restructuring supply chains to reduce exposure, and quietly preparing for extended periods of demand shock. This is defensive posture on a scale that mirrors pre-recession behavior. Some firms are even drawing up contingency plans for geopolitical disruptions that could sever trade routes or freeze international operations. RAM interprets this as another red flag when the corporate giants that typically lead recovery are instead preparing to hunker down. It's a clear sign of what they believe is coming. They also flagged something more psychological, but no less real: a dramatic shift in consumer tone. Social media sentiment, online spending behavior, and RAM's digital tracking tools are all painting the same picture: fear, not just of recession, but of long-term decline. Posts about side hustles, food insecurity, housing unaffordability, and financial burnout are dominating conversations across every major platform. And this digital anxiety, RAM suggests, is more than just chatter. It reflects a growing nationwide sense that the rules of success have changed, and the old playbooks don't work anymore. RAM calls this the beginning of an economic identity crisis. When people no longer believe in upward mobility, when the dream becomes a burden instead of a goal, the entire economy loses momentum. People spend less, save more if they can, and avoid risk. That collective behavior has a compounding effect. RAM believes we're dangerously close to crossing that threshold. And as all of this unfolds, perhaps the most chilling part of RAM's report is their warning that the data we're seeing now may still be lagging behind reality. Good, they're also tracking how this moment is different from past downturns. In one key way, the absence of a clear recovery engine. In 2009, it was tech. In 2020, it was stimulus and digital transformation. But now, RAM doesn't see a breakout sector on the horizon. No new wave of innovation. No strong global demand rebound. No obvious tailwind to carry the economy forward. That vacuum, they say, is what makes this slowdown so dangerous. It could last longer, cut deeper, and hit broader than any downturn in recent memory. Their models show stagnation lasting not for quarters, but for years, unless bold and coordinated action is taken across monetary, fiscal, and private sectors. But even if that action comes, RAM warns it may only cushion the fall, not reverse the trend.